Welcome back to REIQA.com Real Estate Education Program. Be sure you started with the welcome video and have already completed sections 1 through 12. In section 13, we discuss real estate taxes and asset protection. Please subscribe to our channel, like this video, and ask any follow-up questions in the group. Our experienced investors will respond throughout their days to help you. Check out our website at REIQA.com and the links in the description below for more real estate help, tools, and resources. Now, let's begin section 13. Let me start by clarifying that I am not a CPA, accountant, attorney, or licensed advisor of any kind. This video is for general information only and not legal, investment, or tax advice. You should do your own due diligence and seek professional counsel prior to making any kind of investments, legal or tax changes, or doing anything mentioned in this video. So, let's look at: is a real estate sale reported to the IRS? Yes, unless it was your primary residence at least 2 of the last 5 years and the sales price was under $250,000 if single or $500,000 if married. So, if you are double closing, flipping, or holding longer term and selling, all sales will be reported to the IRS. And depending on a lot of things, it could be considered active or passive income, short-term or long-term capital gains. So, should you set up an LLC? I get asked that question almost every time I talk to a new aspiring real estate investor or wholesaler. At first, just do some deals to see if this business is really for you or not. Then after you realize it is, ask yourself these questions. First, should you do a DBA or sole proprietorship, or an LLC or Series LLC, or an incorporation, or C Corp, S Corp, limited partnership, trust, revocable, irrevocable, or living trust, etc.? Are you wholesaling, flipping, renting, raising private money, etc.? What state are you in, but do you do business in other states? Are you single or married? Do you have children, stepchildren, or both? Do you have a W-2 job, 1099, both or neither? What about your spouse? How much do you make? How old are you? How old are your kids? Will you live in the same state in retirement? Are you getting overwhelmed yet? You should be. That's what the professionals are for. Contact a CPA, an attorney, and have a consultation to discuss your business and family structure, income, assets, etc., and let them advise you on which is best for you. Everyone has different individual needs, and there's many alternatives and ways to properly protect your business and family. What works for me may not be best for you. Now, let's discuss rental property deductions. If you own a rental property, you may be generating additional income that could be subject to taxes. However, you may not have to pay taxes on all of your rental income. In fact, many landlords do not have any taxable rental income year after year, even if their properties are profitable, because there are many deductions landlords can use to reduce or even eliminate their taxable rental income, including mortgage interest, insurance, property taxes, repairs and maintenance, utilities paid by you as the landlord, property management, advertising costs, legal expenses, travel expenses, depreciation, and qualified business income, or QBI. Using these deductions can reduce your taxable rental income dramatically. What if your deductions exceed your rental income? As previously mentioned, it is not uncommon for rentals to have a loss for tax purposes, even if they earned a profit. In other words, it is common for deductions to be greater than the property's rental income, especially with depreciation. This is known as passive activity losses. So, what about taxes as a wholesaler? Yes, you have to pay the taxes on any money you make as a real estate wholesaler, but you will only pay taxes on your profits. If assigning, it's like the property seller and end buyer did the deal with each other. They would be responsible for paying the property taxes. Your assignment fee would be more like a 1099 payment. If double closing, you're actually owning the property, even if only for a brief period of time. Since real estate is considered an investment and asset, its taxation will typically fall under the long-term and short-term capital gains guidelines, depending on whether you held the property for over or under 12 months. You may still qualify for some of the standard tax deductions that can be applied to any profits from a real estate transaction, including home office expenses, travel expenses, vehicle expenses, advertising, etc. Again, you should consult with your local tax advisor to make sure you take advantage of all legal deductions and do not claim anything that would get you into trouble. Now, let's discuss the 1031 exchange. Section 1031 of the IRS Code contains arguably one of the most powerful provisions of the tax code for real estate investors, known as the 1031 tax exchange. Most investors use 1031 to help grow their portfolios. Here's a short explanation of how it works. A Section 1031 exchange allows you to exchange like-kind investment properties without triggering the payment of capital gains tax. So, if you decide to sell a rental property that you have a lot of equity in, either because you created built-in equity by purchasing it right, or the equity has increased from both depreciation deductions and appreciation of the property values increasing. Without a 1031 exchange, you would owe capital gains on the profit between the depreciated value and the sales price. This could be a significant amount and tax hit. But if you plan to roll that capital into another like-kind or similar property of the same value or more, you can take advantage of 1031 exchange. You can continuously defer the capital gains taxes as you continue to grow your portfolio. But understand, you will still have the capital gains tax once you sell it in the future without doing another 1031 exchange. This just kicks the taxes down the road so you can swap from one property into another without the tax hit. Now, let's discuss investing in real estate using a retirement account, which offers certain tax advantages that can help you save money and maximize your returns on your portfolio growth. One of the biggest benefits of using a retirement account to invest in real estate is the potential for tax-deferred growth. This means that any income or capital gains generated by your real estate investments will not be subject to taxes until you withdraw the money from your retirement account. This can provide a significant boost to your returns, as you won't have to pay taxes on your earnings until you're ready to retire and start taking withdrawals. You can also use a self-directed IRA or solo 401k to invest in real estate and other assets. A self-directed IRA is for those who have W-2 jobs, whereas a solo 401k is for those self-employed and has much higher limits because you can contribute your individual limit plus company contributions since you own your business. I also highly suggest looking into adding a Roth account also. Regular accounts are tax-deferred, meaning you put pre-tax money into the account and do not have to pay taxes until you start taking money out during retirement. With a Roth account, the money is already taxed before putting it into the retirement account, so all the growth and when you start taking money out is never taxed again. In other words, you pay taxes on the seeds, not the harvest. I own several rentals, private equity in businesses, and other assets inside my Roth. You can also use leverage in combination with your retirement account as long as it's non-recourse. Of course, there are many rules to using your retirement account. So, you'll need to be careful to avoid making any prohibited transactions, which can result in penalties and taxes. Overall, investing in real estate using a retirement account can be a smart way to grow your wealth and plan for your future. By taking advantage of the potential tax benefits and leveraging other people's money, you can potentially maximize your returns on real estate investments and secure a comfortable retirement. Once you get to the point of cash flow freedom, you'll be glad you started contributing to your retirement accounts and can focus on growing both your monthly cash flow and your retirement cash flow and assets. I use Neighbors Group to manage my retirement account. There's a link to their website in the description below this video. Again, I am not a CPA, accountant, attorney, or licensed advisor of any kind. This video is for general information only and not legal, investment, or tax advice. You should do your own due diligence and seek professional counsel prior to making any kind of investments, legal or tax changes, or doing anything mentioned in this video. That concludes this section. In the next section, we will discuss investing in real estate tax liens and deeds. Please subscribe to our channel, like the video, and ask any follow-up questions in the group. Our experienced investors will respond throughout their days to help you. Check out our website at REIQA.com and the links in the description below for more real estate help, tools, and resources.